Hello and welcome back to Digital Dollars. Whether you're just starting your career, building a family, or planning for retirement, understanding and avoiding financial mistakes can have a significant impact on your financial future. The financial mistakes you do in your 20s, 30s, or 40s will haunt you for the rest of your life. Not only you, but your loved ones too. So let's take a look at how to avoid them. The financial mistakes to avoid in your 20s. Your 20s are a time of exploration and self-discovery, but they're also a critical period for setting the foundation of your financial life. Let's talk about some common mistakes to avoid during this decade. Number 1, not starting to save early. One of the most significant mistakes is delaying your savings. The sooner you start saving, the more time your money has to grow. Even small contributions can add up over time. Even if you can only contribute a small amount each month, it's a step in the right direction. Make saving automatic by setting up automatic transfers from your checking to your savings account. This ensures that you're consistently putting money away without even thinking about it. Number 2, ignoring student loan debt. Many people graduate with student loan debt, and ignoring it can lead to financial stress. Create a repayment plan and explore options like income-driven repayment or refinancing to manage your loans effectively. One of the most significant financial challenges that many people face in their 20s is student loan debt. It's easy to push this issue to the back of your mind, especially when you're just starting out in your career and other expenses are demanding your attention. However, ignoring your student loan debt can lead to long-term financial consequences. Ignoring student loans can lead to a variety of negative outcomes. First, failing to address your student loan debt promptly can result in late fees, penalties, and damage to your credit score. This can affect your ability to secure favorable interest rates on loans, credit cards, or even your ability to rent an apartment. Student loans typically accrue interest over time. This means you end up owing much more than the initial loan amount. The longer you delay addressing the debt, the more interest will accumulate, making it even harder to repay in the future. Ignoring student loan debt can also limit your financial flexibility. If you're carrying a significant student loan burden, you might have less disposable income to invest, save, or spend on other important life goals, such as buying a home or starting a family. Number 3, living beyond your means. The allure of instant gratification. It's easy to succumb to the temptation of spending money on things you desire, but when your spending consistently outpaces your income, you're headed for financial trouble. Living beyond your means essentially means spending more money than you earn. This often leads to accumulating credit card debt, high interest loans, and a cycle of financial stress. Sure, having the latest gadgets, dining out frequently, and indulging in spontaneous shopping sprees might provide short-term happiness, but they can wreak havoc on your long-term financial stability. The antidote to overspending is creating and sticking to a budget. A budget is a powerful tool that helps you allocate your income toward your essential needs, savings goals, and discretionary spending. By tracking your expenses and setting limits on discretionary spending, you can ensure that you're not straying beyond your means. It's essential to distinguish between needs and wants. Needs are things that are essential for your well-being and basic survival, such as housing, food, utilities, and transportation. Wants, on the other hand, are things that enhance your lifestyle but aren't crucial for day-to-day existence. Prioritizing needs over wants allows you to make informed spending decisions that align with your financial goals. When you live beyond your means, you often turn to credit cards or loans to bridge the gap between your income and your expenses. This can lead to high-interest debt that accumulates quickly, making it even more challenging to get back on track. Making minimum payments on credit cards can keep you trapped in a cycle of debt, prolonging your financial struggles. Breaking the cycle of living beyond your means requires a mindset shift and disciplined actions. Start by assessing your current financial situation. Calculate your total income and compare it to your expenses. Identify areas where you can cut back and create a realistic budget that aligns with your income. Avoid making impulsive purchases and prioritize saving for emergencies and future goals. Number 4, not building an emergency fund. Emergencies can happen at any age. Having an emergency fund can provide a safety net and prevent you from going into debt when unexpected expenses arise. An emergency fund is like a financial safety net, and it's an essential tool to have in your financial arsenal. This fund is specifically designated to cover unexpected expenses that life may throw your way. Whether it's a medical emergency, a car repair, a sudden job loss, or even a global crisis like we've seen in recent times, having a well-stocked emergency fund can provide you with peace of mind and help you weather the storm without derailing your financial goals. Imagine this scenario. You're in your mid-20s, just starting your career, and you haven't built an emergency fund. Suddenly, your car breaks down, and the repair costs are substantial. Without an emergency fund, you might be forced to put the expense on your credit card, leading to high-interest debt that could take months or even years to pay off. This situation not only sets you back financially, but also adds stress and uncertainty to your life. Now, let's take a look at financial mistakes that you need to avoid in your 30s. In your 30s, you're likely juggling more responsibilities and financial goals. Let's discuss some financial pitfalls to avoid during this phase of life. Number 1. Not investing for the long term. In your 30s, you might be focused on saving for short-term goals like buying a home or starting a family, and that's important. Diversify your investments and consider stocks and other long-term assets to grow your wealth. Another reason investing for the long term is crucial is that it allows you to take advantage of the potential rewards associated with higher-risk investments, such as stocks. Stocks tend to have higher returns over the long term, but they can also be more volatile in the short term. Retirement might seem far away in your 30s, but it's a goal that requires careful planning and preparation. Neglecting long-term investing can lead to a shortfall in your retirement savings. Number 2. Accumulating high-interest debt. Credit card debt and high-interest loans can become a significant burden. Avoid accumulating this type of debt and prioritize paying off existing balances as quickly as possible. High-interest debt includes credit card debt, payday loans, and other forms of borrowing with high annual percentage rates. These types of debt can quickly spiral out of control if not managed carefully. The interest rates associated with these debts are much higher than those of traditional loans, making them a major burden on your finances. Fortunately, there are strategies you can implement to steer clear of accumulating high-interest debt. Start by creating a detailed budget that outlines your monthly income and expenses. This will give you a clear picture of where your money is going and help you identify areas where you can cut back on unnecessary spending. If you already have high-interest debt, make it a priority to pay it off as quickly as possible. Consider using strategies like the debt avalanche or debt snowball method to efficiently tackle your debt. While credit cards can be convenient, using them for non-essential purchases can lead to overspending. If you're struggling with multiple high-interest debts, look into options for consolidation or refinancing. Consolidating your debts into a lower-interest loan can make it more manageable to pay off. Furthermore, carrying high-interest debt can negatively impact your credit score. A lower credit score can result in higher interest rates for other types of loans, making it even more challenging to manage your finances effectively. Number 3. Not updating your budget. Your financial situation evolves, and your budget should too. Failing to regularly review and update your budget can lead to overspending or missing out on new opportunities to save. When you create a budget, it's a snapshot of your financial situation at that moment. However, as life changes, your income, expenses, and financial goals may evolve. In your 30s, you might be focused on paying down student loans, saving for a down payment on a house, or planning for a family. These changing priorities mean that your budget needs to adapt to accommodate new financial goals. With more years of work experience, you're likely to see increases in your income. This extra money can be a great opportunity to allocate more towards savings, investments, and paying off debt faster. You might start a family or experience other lifestyle changes that impact your expenses. Childcare costs, family vacations, and other new expenses need to be factored into your budget. Life is full of surprises, both positive and challenging. An emergency fund is crucial, but your budget should also account for unexpected expenses like medical bills or car repairs. As your income grows, it's easy to fall into the trap of lifestyle inflation, increasing your spending to match your higher earnings. Regularly reviewing your budget helps you avoid unnecessary spending and stay on track. Finally, you reach your 40s, and these are the financial mistakes you need to avoid at this time. As you enter your 40s, retirement planning and wealth preservation become even more crucial. Number 1. Ignoring health and long-term care costs. Health expenses can increase as you age. Ignoring the potential costs of healthcare and long-term care can derail your financial plans. Consider health insurance and long-term care insurance options. Healthcare costs tend to rise as you age, and the 40s are a time when you might start experiencing health issues or require regular medical checkups. Failing to account for these expenses in your financial planning can be a major financial pitfall. Medical bills, prescription costs, and health insurance premiums can all add up quickly. One way to address these potential costs is by considering long-term care insurance. Long-term care insurance can help cover the expenses associated with long-term care services. However, it's important to carefully review policy terms, costs, and coverage limits before making a decision. Number 2. Overextending yourself to help others. While it's important to support loved ones, overextending yourself financially to help others can jeopardize your own financial stability. Set boundaries and communicate openly about your limitations. While your intentions may be noble, it's essential to set clear boundaries when it comes to financial assistance. Establishing limits on what you can reasonably contribute without jeopardizing your own financial stability is crucial. Communicating openly with those seeking your help is essential. Discuss your own financial commitments, goals, and limitations. This open dialogue can help them understand your situation better and prevent misunderstandings. Your financial goals, such as saving for retirement, paying off debts, or building an emergency fund, should take precedence. Make sure that any assistance you provide aligns with these goals and doesn't compromise your own financial security. Financial assistance isn't the only way to support others. Consider offering your time, skills, or expertise instead of solely relying on monetary contributions. This can be equally valuable and meaningful. It's easy to feel guilty or pressured into providing financial support, but remember that your well-being matters too. Make decisions based on what you can afford and what aligns with your values. Number 3. Not adjusting your investment strategy. Your investment strategy should reflect your changing risk tolerance and goals. Failing to adjust your strategy as you age can lead to missed opportunities or increased risk. In your 40s, your financial priorities might shift. You might be focusing more on wealth preservation, funding your children's education, or preparing for retirement. Your investment strategy should align with these new priorities. As you age, your ability and willingness to take on risk can change. With fewer years until retirement, you might not have the same capacity to recover from market downturns. It's important to reassess your risk tolerance and adjust your investments accordingly. As you approach retirement, you might want to consider adding income, generating investments to your portfolio, such as dividend-paying stocks, bonds, or real estate. These can provide a steady stream of income to support your lifestyle. Adjusting your investment strategy can be complex, especially as your financial situation evolves. Consulting a financial advisor can provide you with personalized guidance tailored to your goals and risk tolerance. And there you have it. Avoiding these financial mistakes in your 20s, 30s, and 40s can set you up for a more secure and comfortable financial future. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more valuable insights into personal finance. Thanks for watching, and we'll see you in the next one.